Hey folks, welcome to a portfolio review at Finominal. Today we're going to look at a global growth model portfolio from American funds. So let's kick off in terms of what this portfolio is comprised of. And if you look at the underlying holdings, we do see that effectively it's 8 mutual funds from American funds. The largest one is a new perspective fund with a 20% allocation, followed by a growth fund with 15%, and a new economy fund of also 15%. Now, the fees are quite high for each of those mutual funds. And if you look at the total fees for this portfolio is 56 basis points. Now, that's not particularly cheap. So let's see if it's worth paying for the portfolio. And we can have a look at the benchmark, which from our perspective, as well as for American funds, is the MSCI ACWI index. Now, if you look at the performance of the current holdings, going back in time, well, all the way to 2011, we do see that that portfolio actually outperformed. So that's great. Having said that, that's only the performance of the current holdings and not the actual track record of the portfolio. So let me get the fact sheet over here. And over here, we do see that, well, there's a strategy inception date in 2012. But the model itself was created in 2016. And over here, we do see the lifetime CAGRs of this portfolio. Now, gross of fee, it's 11.85 versus the MSCI ACWI is 11.46. We can also look at the net returns, but this is less, a 3% fee, which seems to be a high side. So it's just worth contrasting 11.85 versus 11.46. So in the face of it, actually American funds has created value. And if you can get this portfolio without paying model fees, advisor fees, and transaction costs, it has actually outperformed its benchmark. But in reality, right, after transaction costs, after exiting its portfolio versus an advisor, right, this fund unlikely has outperformed the MSCI ACWI. So that's with regards to performance. But let's actually evaluate if the ACWI is the relevant index. And we can have a simple look at asset classes. I mean, it's an equities portfolio, right? Global growth. We do see that American's fund portfolio has a slight allocation lower to the S than the MSCI ACWI. We can also see it has a slightly lower allocation to large caps. And if we then move to sectors, we do see some differentiation. So here we can see, for example, there's two notable overweights. So the largest overweights that American funds has is industrials versus MSCI ACWI. Also a slight overweight in healthcare. And the largest underweights are in consumer staples, energy, and financials. So that's kind of interesting to see in terms of from a sector perspective. If we change the perspective to looking at the factors, so here we can see the effective betas for popular equity factors, but it does look like a little bit like a very messy chart, and effectively simply means that this portfolio didn't have any consistent factor exposures because they're all over the place. And we can make the point even clearer that if you look at how equity factors have contributed to the overall risk of this portfolio, it's been marginal. So it's primarily the stock market or the global stock market, right, that dominates the risk, which you can see over here. Now, has this portfolio been constructed thoughtfully? And one way to look at that is by seeing if you have funds in here that have opposing factor exposures. And unfortunately, we do see that American funds has put in funds in here that have opposing factor exposures. So for example, there is a small cap fund here, the small cap world fund, which of course has a positive beta to the size factor because it includes small caps. Having said that, we also do see other funds in here like the new funds fund, right, or the growth fund, right, and these tend to be large caps. So effectively, right, the betas net themselves off, and that also explains why factors don't really matter so much for portfolio, right? Because warm water or like hot water and cold water just ends up with lukewarm water, right? So effectively, you're ending up with a portfolio of funds that have meaningful factor exposures on their own, but given that they're partially opposing, they net themselves off, and you're left with a portfolio that is pretty plain vanilla, but you have to pay high fees for it. And so this kind of leads us to our next question. Can we reduce the fees of this portfolio? So over here, for example, we see the funds and portfolio, and we can see ETFs that provide exposure to standard benchmarks. And indeed, so each of the funds in American's funds portfolio could be replaced with something. And if you would do that, we would reduce the total portfolio fees from 56 basis points to 7. And actually, the kind of like optimized or cheaper portfolio would have had a much higher return. Now, the final question is, can this portfolio be simplified? I mean, it's a portfolio comprised of 8 funds, right? 8 equity funds to be precise. And unfortunate answer is yes for American funds, right? Because we can simply replicate this portfolio comprised of 8 funds with 2. This is simply the investor QQ, which is the Nasdaq, plus kind of MSCI ACWI equivalent, the Vanguard Total Stock Fund. And as you can see, the simplified portfolio, we only have 2 funds would have had a higher return and lower fees at 8 basis points versus 56. So this kind of concludes our short review of American Fund's global growth portfolio. To be fair to them, the actual track record does show an outperformance versus the MSCI ACWI. It's only questionable if you can get a hold of that portfolio without paying any fees and unfortunately the out transaction cost, right? So that probably negates any outperformance. And then there are these other points made that effectively you can get the same risk exposure as portfolio at a much lower cost, and you can also simplify this portfolio from 8 to 2 securities. Hope that helps. Have a nice day.